This is practice exercise number 2 from Chapter 13, Statement of Cash Flows. Here we're going to look at the adjustments to net income using the indirect method. And we're only considering the first couple of adjustments here. We're going to be considering those things which do not affect cash that are reported on the income statement. We have, in this case, Lighthouse Corporation's accumulated depreciation furniture account increased by $8,700. While $5,600 of patient amortization was recognized between balance sheet dates. There are no purchases or sales of depreciation or intangible assets during the year. In addition, the income statement shows a gain of $6,600 from the sale of land. We need to reconcile the net income of $99,000. Thinking of depreciation and amortization, those do not actually require cash. We are going to report depreciation and amortization each year. Okay, we make an adjusting entry. When we originally purchased the item that's being depreciated, that's when the cash outlay was. Now we're recording using depreciation or amortization how much has been used up of that asset. So we're showing the decline in how much is still usable. So we're going to be adding that back. Even though we're recording that adjustment entry, we're decreasing our net income with that expense and accumulated depreciation. We need to add that back when we're converting it from the accrual basis to, in essence, the cash basis. So I'm going to start off with my net income of $99,000. I'm going to add those expenses which do not require the outlay of cash. One of them is going to be depreciation. My depreciation is I'm going to add back $8,700 because we recorded an adjustment there of $8,700. I'm also going to add back my amortization, the amortization being $5,600. So I'm going to add both of those back as a item to our net income because those are reported as an expense on the income statement but did not require an outlay of cash. So my additions are going to be $8,700 plus the $56. Now I also need to consider the gain that was reported of $6,600. That gain does not represent the inflow of cash. The inflow of cash is the sale of that land. For instance, if I were to show you how, let me get myself a little more room here. Okay. If I sell this land, I'm going to have land that I sold at, say, $66,000. My original cost of the land was $50,000. Then my gain on that land is $6,600. The actual cash that we're going to receive is the $66,000. That's how much cash. That's going to be reported in the investing section as additional cash. So if we left the gain on the income statement, we'd double report it. So we're going to neutralize that, and I'm going to take the gain on the sale of land, $6,600. I'm going to subtract that. My total adjustment then is going to be $8,700 plus $5,600 minus $6,600. So my total adjustment is going to be a decrease of an increase of $7,700. So that's going to be my net increase. clean this up a little bit. So now my net cash flows from operating activities, I can add that $7,700 to my net income. So I'll take 99,000 plus 7,700, and that equals 106,700, and that's going to be my net cash flows from operating activities.